I believe there are three types of investors. There's those that need appreciation. There's those that need cash flow, and there's those that need tax benefits. And if I ask them, what are you? Everybody always says, I want to be all three. And Tim, to be honest, I wished I was 6'8" and playing in the NBA. I'm just a 5'8" white guy from Idaho that's not got a shot at the NBA. So the reality is there's a lot of investors out there with $100,000 or $200,000 that think they want cash flow. But at 8% cash on cash is not going to change their life. They really need to find a way to take that 200,000 and get it to grow.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder and CEO of Zana Investments, Tim Little. And on today's show, we have with us Shannon Robnett. Shannon is the founder and CEO of SRI, Shannon Robnett Industries, and has been involved from start to finish on over $425 million in construction projects. Along with his team at SRI, Shannon is dedicated to sharing his expertise and delivering top quality projects that bring in numerous passive income streams to his syndicate partners. Shannon, welcome to the show.
Thanks, Tim. I appreciate you having me on.
Yeah, and it's great to have you. So I'm excited to get into this. I gave everyone a high-level overview of your background, but on this show, we really like to get into the details of how you got started on your journey. So please take us back to the beginning and tell us how you got to where you are today.
Tim, I had the advantage and privilege of being born into a real estate family. My father was a builder and my mother was a realtor. And so I learned at an early age everything that Robert Kiyosaki talks about in the book, Rich Dad, Poor Dad, because my parents were poor dad. And I saw them always talking deals at the dinner table. I thought I was going to go the college route and do something new. And I quickly saw that my brother, my younger brother, was making more money than the career I was going into building houses. And there was no reason why I couldn't do that. So I promptly, one semester later, left college, to which none of my professors even noticed, and went back and started building houses. And from there, I realized that I didn't really like homeowners very much. They were too picky. They wanted everything perfect, even though they didn't want to pay for it. And so I shifted my company into the commercial world. And from there, we built police stations and fire stations, city halls, medical facilities, schools, gymnasiums, just about anything out there, mini storage included. And I realized that as I was building all of these projects for people, they were going to be the ones that continued to get rich, because I saw my parents at the age of 50 retire on cash flow. And I saw that every time I turned over another project, I had to go find another one, and I had to keep my pipeline full of deals that I could do, that I could make a paycheck. And one of the other things I'd learned along the way was that I didn't like paying taxes. And so I really honed my skill set to where everything that we do is tax advantaged. We look at the tax implications first and foremost. Not that they change the deal, but the way you structure going in is oftentimes the difference between massive tax savings and none. And so over the last 5 years, I've transitioned my company from a for-hire construction company to one where we just build and develop our own product. And now that we're expanding in other markets, Houston, Nashville, North Carolina, Florida, I've actually created another evolution where we're working with other general contractors to actually perform the project rather than us self-performing everything. And so it's been quite a ride. We continue to see, even in what everybody refers to as the new economy or the new interest rates, which I got to tell you, Tim, having done this for 25 years, these interest rates are still absolutely fabulous compared to the majority of my career. So we're still doing things the same way, still underwriting the same way we always do, and still lots of deals coming down the pipeline and seeing lots of prospects of new projects happening in 24 and 25.
Yeah, and I think you brought a little bit of perspective there for especially some of the younger listeners who may have gotten a little bit spoiled by the artificially low interest rate environment, I'll call it. And so even now, what seems high to us in the present is not high in a historical context. Granted, I don't want it to go up to numbers that I've seen in the 80s on charts. I was
Right.
buying houses
Right.
at the time. But still, yeah, I think a lot of people need to take the broader view on that one. And I think the greater point is, regardless, deals will still get done and people will still make money. That's the important part.
Yeah. Tim, a lot of times over the last couple of years, people were buying deals um, that seemed to make sense, but they didn't necessarily cash flow. The market was hot. People were buying things and they were hypothesizing about the fact that if I get the $100 rent bump, or if I do this, or if I do that, then it will cash flow. And being from the old school real estate investment game, if it doesn't cash flow from day one, we're really not interested in it, which may seem funny when you're talking about development deals. But the reality is, I've got third party, everybody telling me whether or not my deal works. So when we're looking at a deal on a development, we've got a takeout loan in there that is telling us what it's got to be. And we've still got to have that 125 DSCR, right? So we've got to have debt service coverage before we start the project. And some of our projects are 36 months long, and we're projecting out where rents are going to be based on what they are today. And in most cases, the market has been very kind to us in that regard. But the reality is, if the deal doesn't pencil from the beginning on development or value add, most people shouldn't be doing it unless they have very deep pockets and a very long term investment horizon, which a lot of people that have gotten into real estate over the last couple of years don't have that perspective. So it's been interesting. Spoiled is one way to put it. I think there was a gift horse that came and looked at all of us. Some of us took advantage of it, some of us did not. I don't think that it's going to be my lifetime or yours that we see those 3% interest rates again.
Yeah, I think that's a fair assumption. I think they may stabilize and go down a bit, but they will likely not go down to the levels that we saw when I like refinanced my house for 2.5%,
Yeah.
for example. No, that's a good point. And you bring up the part about cash flow, and ironically on development, you're starting with a piece of land, right? Compare that with an apartment where you have presumably tenants who are paying. And I think that's why a lot of people shy away from development. There's this perception of risk associated because there's no money coming in. Can you talk about the difference in terms of the risk associated, but also the potential reward, which I've seen can be higher with development versus like a value add multifamily play, for example?
Tim, you bring up a lot of good points there. And the real thing is, we are creating the original value add, right? When you're buying somebody else's apartment complex that they're selling, they've come to the place where it either probably likely needs another cash injection, it needs new deck chairs by the pool, you need to repaint the clubhouse, you need to redo units in the buildings. And we're creating that original value add. We're taking the sticks and stones at a cost of X, and we're adding the tenant, which brings into play the cap rates, which really change what's happening because we take it from raw materials and create that cash flow. And the reality is that most people are looking at it and they're seeing that, okay, there's risks involved, but Tim, how many people have bought apartment complexes or done real estate deals and they find out that their inspections weren't as thorough as they need to be, or they've got mold, or their costs to do things to retenantize are much higher than they expected. And they're doing a lot of that where they were able to come in with 20% down and the bank financed the majority of the value add. And they were doing these things and they were in flux on an interest rate, and now all of the chickens have come home to roost, and they're finding that they're not in the cash flow position they thought. They'd spent the additional money. Interest rates are higher. And so there's a lot of things working against them at this point. And when we look at that, like I said, when we start a project, our construction lender is already looking at our takeout loan and saying, okay, are you going to be able to make it? And we don't get the benefit of the escalatory rents, right? We get the benefit of looking at it going, these are the rents today. And these are not what we think they are, where we've cherry picked that this unit and this unit, they've taken a blended rent for the area. We've got the appraisal that says this is all the project will be worth when it's done. And I don't care who you are, there's not a developer on the planet that's come back and said, wow, I really like that appraisal, right? We've always been shorted, we feel, by the appraiser, which means we bring more capital to the game, but we have interest reserves built in. And so we've got all the interest that's necessary for the project and the construction timeline. so that as we build that out, we're secured in that fashion that we know that we don't have rents, but we've got a timeline and we've got a construction project that's happening. So as we come along, we've seen, and we usually see rents continue to go up rather than down. People are saying that rents are going down right now. They peaked. Okay. Let's put it that way. We can't do 15% year over year for 10 years in a row. There comes a point when it peaks and it lets off a little bit. And so we've seen that happen. And we're now starting to create a solid base for this is what rents are going to be for a while. And we're putting them back into the pro forma that says that we're going to get 3 to 5% rent bumps annually, like we've gotten for decades. The other thing that happens with development, Tim, is the underwriting is a lot more conservative. W- we're never in a bid situation ever on development. We control the property. We've got it entitled. We've got our business plan. We're moving that forward. The only person that we're competing with is the communities around us and what the rents are. And that perspective that's brought to us by the appraisal really keeps us, I think, a lot more grounded in what we're doing. Part about the development that I think is notable to point out is banks will loan you on a value add based on the asset. So a lot of people that maybe didn't have the resume to pull off the project were getting bank loans because the asset was already performing to a degree that the banker felt comfortable. In construction and development, the bank is very concerned about the resume of the party that's doing the work. And we've spent, like I said, I've been in the business for 27 years. We've spent the majority of our life in business building that resume to show the banks that we can perform, that we can execute, that we can deliver. And when you put together that team and you've got a track record that is there, that are knowledgeable people that have years of expertise in the business, your likelihood of being successful is much higher. And so the bank is honestly helped us stack the deck in our favor more so than it would with a value add operator who's just coming in and ad hoc going, wow, I want to get into real estate. I'm going to get with these other two guys. We're going to raise a couple $1,000,000 and we're going to buy a deal. And then we're going to figure out how to operate it. You can do that. And I'm not saying there's not a lot of people out there that are smart enough to do that because real estate is not difficult. It's very repetitive. But when you're looking at it going, okay, how do we operate during difficult times? How do we operate when the proverbial shit hits the fan and we can't get materials or we can't get tenants or things aren't working the way we wanted them to? Those are the times when the experience of the operators really come into play because we've seen that. We've been there, we've done that, and we're doing it again. And so I look at that kind of saying, okay, yeah, if you really break it down, there are more there are longer risks involved, but I think that the deck is stacked in the favor of the developer with the way that the banking process happens, the way that the city processes happen, so that you're not as likely to see in this next downturn that's coming as many development operators caught over a barrel as you are seeing value add operators taken out on a weekly basis at this point.
Yeah, that's interesting because you shift the risk dynamic, right? You take it from, yeah, like people have this perception of risk for development. But what you're saying is the processes, the oversight, everything else that's in place, the conservative underwriting, it's to an extent that it's mitigating much of those risks. Where on the other side, in multifamily value add, you have a lot of new people coming in, maybe doing it for the first time. Banks are giving them more credit than they deserve, maybe for their background, because they're leveraging maybe the experience of the team and stuff like that, which makes, yeah, vetting your sponsors so important for
Right.
all those people in multifamily syndication. But with you guys, it's almost as if the system itself is vetting you to ensure that you have the requisite experience, conservative underwriting, etc., in order to, as safely as possible, get that deal done.
You're exactly right, Tim. And the other thing is when I come to market, I'm coming to market with a brand new product, right? There's a lot of people that have bought value add. They're dealing with 8-foot ceilings that still have the popcorn on them. They're dealing with older product. They're dealing with high maintenance costs. They're dealing with expensive repairs and they're dealing with a lot of unseen things where we're coming into the market. We've got the 9-foot ceilings. We've got the dog wash. We've got the dog park. We've got all the modern amenities. We've got Wi-Fi throughout the complex. We've got all the things, all the new things. And so we're able to be more competitive on what we offer. and not having to take the discount because of what we have. We are top of the market. And when you look at what's going on in the market, the bottom of the market, the C's and D's are getting squeezed the most. Their delinquencies are much higher than what they are in the B pluses and the A's. The A plus tenants have a lot more discretionary income. They have a lot less collections. And so I think in most people's underwriting on a value add, they're looking at a 40% operating and expense ratio. We're in the 20s, high 20s, because we don't have air conditioners going out all the time. They're all brand new. And for the first year or two, they're under warranty. And so we're able to do a lot of things with our expenses that maybe a value add operator can't, especially in inflationary times like this.
Yeah. And so I wanted to go back to one of the other things that you were talking about, too, just in terms of your journey. You talked about like you were basically for hire, right? On the construction side, and you decided to make that transition to doing your own thing. Can you talk to me about what that first project was, where it was your own build, what that looked like? And were you a little bit nervous about taking that step? Because obviously all the onus, the risk, and the benefit is on you at that point. It's not just doing a job, well done, here's your check, and you walk out the door.
Yeah, that was back in 2001. It was an industrial building, flex space, and that was back. I couldn't get a non-recourse loan at that price point, and so I was putting everything I had into it and everything I had on the line. But Tim, it's funny because what is it, 20? Yeah, 21 years later, I still have 2 of the same tenants in that building, right? So 21 years later, I don't even have to send these guys a Christmas card for paying off the building for me and taking care of that, but they're there because they needed a place to start their business. Their rents have gone from 32 cents a foot to $1.21 a foot on their rent, and they're still there paying it because where else are they gonna go other than a new building down the street where their clients don't know where they're at, all the employees and everything. And so when I look at that in '01, had I known more the gravity of what I was doing, I think I would have done more faster and made my transition sooner from for hire to strictly investment grade for myself and others. But that was really the journey, and it took everything, and it was scary, but again, I had the benefit of watching my parents do the exact same thing time and time again and walk away from the game that same literally that same year.
Yeah, and I think those lessons that we learn from our parents, both positive and negative, are so
Yeah.
important. And it's why I'm such a huge advocate about talking about money. I always say we have this weird thing in America. I don't know, if it comes from our, Protestant background, like when the Quakers came or something. We don't talk about money. It's considered one of those topics: religion, money, politics. And I'm a huge advocate of talking about money at the dinner table. How does it
Yeah.
work? Lessons learned, etc. And that's why my daughters are only 4 and 7. But it doesn't mean I don't talk to them about it. And I certainly don't baby talk to them about it. I figure, hey, if they don't get it the first time, they'll get it the second, third, or fourth time. So yeah, I think that's huge.
And it's truly the right way to do it because I remember growing up at the dinner table and it was past the mashed potatoes and how do we do a 1031? That was the topics of conversation, right? I couldn't tell you, Tim, how many times my parents got up from the dinner table and went straight to the office to figure out how to put a deal together. And I
Wow.
saw that and I saw that and I didn't realize all of the benefit I was seeing in front of me at that time. Those are lessons that have played out throughout my life that I remember. And I've watched how those kinds of conversations, whether they're completely in tune with them or not at the point of time that they're delivered, can be lessons that they can draw from in the future because they can remember what happened. And a lot of times, Tim, we don't even realize what we've absorbed in that situation until we're faced with that situation. But then we remember what our parents talked about, what we learned, and for me, investing in anything but real estate takes a coaching call, right? It's really something that I have to get my head wrapped around because that's all I ever saw, and I also saw the results. So in that particular area of my parents' life, I was able to look at what they did and see it as the positive, not look at it and go, oh, yeah, my dad lost millions of dollars in the stock market. That's why we don't do that. That wasn't what I saw. I saw real estate take care of my parents. And Tim, by that example, when my parents retired, gas was $1, houses were 150,000 bucks, and they were getting 32 cents in rent. Here we are 20 years later, gas is up 3 times, houses are up 3 times, but so's the rent, right? So they're still living the exact same lifestyle thanks to
Mm.
inflation and the way that all that world works. They're still getting the same dollars in the door, right? They're still getting the same monthly income. They still buy the same amount of things that they were buying 21 years ago.
Yeah, quality of life has not changed because of what they chose to invest in. That
Exactly.
that makes a lot of sense. So I know your company has 3 subsidiaries. Can you please talk about those 3 and what their different roles and responsibilities are, and how that's benefited you through synergies, to use a business buzzword, and helped you guys grow as a whole?
The first one is Phoenix Commercial Construction, and that's really where it all started. We have the ability to understand what our cost impact is of the project with lending and everything else. The second one is vertical equity, which we is our capital raising arm that handles all of our investor relations, that sources deals, because we've gotten to the point where I can't build enough to stay in front of the capital coming in. So we've moved into other markets. We're acquiring value add product in industrial in other markets. And then the other one is the property management. And the property management is vital because if you can't control your expenses, you're going to get out over your skis and you're going to outspend your income and you're going to put yourself in a bad position. But the best part about all of that is having all three of those under one roof. I'm able to have the whole conversation in house. So I'm able to come in and say, "Hey, what's the cost impact if we upgrade this from Formica countertops or laminate countertops to quartz? And what happens? What are we really going to get for rents? And how's that going to affect our need for capital?" So we're able to keep all of those conversations in house instead of involving three different companies with three different objectives. Tim, it's funny. One of the value adds that we did in a new build is we started reselling cable TV, right? So we resell the internet and the cable. And my property management guy initially came to me and he said, "Hey, I think I've got a way to make us another 50 bucks a unit. And on 200 units, that's a substantial chunk of money." And I said, "So what do you think that makes us a year?" And he thought about it for a minute. And he said, "I think about 80 grand after expenses." And I said, "So is that an $80,000 idea?" And he said, "Yeah, I think so, because that's the way property management thinks. They think of NOI." And so I pulled out my calculator and I did the math and I said $80,000 at a 6 cap is 2 point I think it's like $2.4 million, right? I said, "That's a $2 million idea because when you look at NOI and how it relates to the investment grade of the property, it changes things substantially. Yet so many property managers are out there going, I need to save a penny over here. So we're going to leave the rents at $1,800. Whereas if they spent a little bit more and they did it up on the landscaping or they offered a better amenity package or some of those things, they could raise the rent $150, $200, which may cost $50 to do, but your NOI based on the cap rate just made you millions. And a lot of times having those conversations in house is imperative. And that's really what I think has been the secret sauce for us over the years.
Yeah, and I think you bring up an important point that a lot of, especially new passive investors or aspiring passive investors, don't really understand is how multifamily is. And it's not their house or small multifamilies where it's based on comps in the area. Comps certainly come into play, but it's largely valued on like a business, on how much money it makes. And so anytime you can find a way to increase that net operating income, you are inherently increasing the value of that property. So I think that's really important, a really important concept for new investors to understand when they're looking at this and they're listening to the business plan that folks are pitching them and saying, hey, it's a value add. Okay, how are you adding that value? And show
Right.
me the numbers on how these things will impact that NOI. And I wanted to talk to you about your business in terms of the you say you take investors, and are you taking investors for the development phase of projects as well, or strictly for the multifamily and industrial that you're purchasing?
So our business model, we've got a unique way of doing it, but the reality is we bring our investors in at the purchase of the ground and the start of construction. Those are a simultaneous thing. So we're not making money on the entitlement of the ground. We're bringing that value to the deal. One of the things that I've seen, Tim, is if you can underpromise and overdeliver, you never disappoint anyone. And if we're bringing that value of we've got this ground entitled, we bought it for 3 million, it's worth 4.5, that may some people may look at that and go, that's the time to pull out your $1.5 million. I look at it and go, I've got a pretty generous split between my partners and I on how we do that. And I'd rather have that $1.5 million cushion in there so that my underwriting works, my project is on time, it's developed on budget, everything is done the way it's supposed to. And if there's $1.5 million to split at the end between my partners and I, nobody's going to be mad at me. But go $30 the other way, right? If you said you were going to make $1 million, try returning 990 to your investors. They're not going to like any bit of it, right? And so that's really where we do it. So when we close on the land and we're ready for construction, those are a simultaneous thing, and we go through the vertical development process. The other thing that we've also identified, Tim, is there are really, I believe there are three types of investors. There's those that need appreciation, there's those that need cash flow, and there's those that need tax benefits. And if
Mhm.
I ask them, what are you? Everybody always says, I want to be all three. And Tim, to be honest, I wished I was 6'8" and playing in the NBA. I'm just a 5'8" white guy from Idaho that's not got a shot at the NBA. So the reality is there's a lot of investors out there with $100,000 or $200,000 that think they want cash flow. But at 8% cash on cash is not going to change their life. They really need to find a way to take that 200,000 and get it to grow. There's those that are at later in life, they're in their mid to late 60s, they've got a couple $1 million. They do not want the risk of a ground up development project. They just want cash flow. And then there's those that are looking at it going, man, I make a ton of money where I'm at. I'm a doctor, I'm a lawyer, I'm a C-suite guy or gal, and I'm making great money. What I would really like to do is save 35% on what I'm making. And so we look at the tax advantages and focus in those areas. And so we're really able to get people in a place where they understand what they really need and they get there so that they can get the result that they really want. I've seen time and time again, somebody with $100,000 to invest is stuck in a 6 or 7% cash on cash deal for 5 years. And they're looking at it going, how is this supposed to do anything for me? I really need my 100 grand to become 3 million in the next 20 years. What's my plan to do that? And so really that's what we look at to ensure that we're delivering to our investors the best value and the best product type. And so we have different ways that we transition them through the projects that help with the tax advantage, that help them understand that this is appreciation. We're going to build this project, we're going to exit it, we're going to build another project, we're going to exit it. Instead of trying to hold on to everything forever, we're going to make sure that we are as efficient as possible with their time and their money.
Yeah, and I think there's a couple of like really big points in there again for those passive investors. One, know what your priorities are. Like you said, if you can get all three, it's probably going to be a little bit of all three. But there's some deals that are just skewed towards one advantage more than the other, right? Like you said, the cash flow may not be amazing. Maybe it's a 6 or 7 prep. But if the person is not interested in that cash flow and they're like, I want a 2x equity multiple, like I want my money to double in 5 years, maybe that deal offers that. And that's what they're more concerned about because they don't need the cash flow. But if
Right.
that person does need cash flow, then that's probably not the right deal for them. And more sponsors need to be willing to say, hey, this deal probably isn't right for your investing goals. You might want to pass on this one, but if I have one that comes up that is more in line with your investing goals, then I'll certainly bring it to you. And I think the other piece for sponsors is helping that expectation manage, right? So that people don't get frustrated 1 year into a deal at what they're seeing, because if the communication had been there up front, then they probably that place in the first place.
Yeah. And Tim, I think that the way that you pose that shows the maturity that you have and that a lot of syndicators may not have is looking at it through the eyes of your investor. A lot of syndicators look at it and go, man, money's money. I'm going to take what I can get. The others of us that have been in the business a while want to make sure that whoever is in being in, on our investment side is doing what is right for them based on what we know, right? And making sure that they're not going to wind up with a result that's contrary to what their investment thesis is. Because if you've got the right guy in the wrong deal, you may have his money this time, but you likely won't have it for the next deal. We're more concerned about the relationship and building out what you need for your successful future so that you're getting the results that you want. Then it's very easy for me to meet that expectation. But if you're needing appreciation and I put you in a cash flow deal, I'm not going to meet your expectations. So I have your money for one round. If I put you in the right deal for you and you get the results that match your investment thesis, you're going to really feel comfortable reinvesting with us and doing it again and again. And our track record with our investors proves that. We have probably an 85 or a 90% reinvestment rate.
Wow. Yeah. And so to better understand what it looks like, if you say have a development deal, what is the time in on that? Like how long of a hold is that for investors? Or do you do it in like phases and they're able to shift to, I've seen like some folks set it up as different phases of an investment or
Yeah.
transition them out into a different investment that you have so that they can again diversify themselves and get into something that's more in
Yeah.
line with what they want.
What we do with that, Tim, is we start out, we've got a 60 unit apartment complex. It's a little bit of a small one. That's going to be done start to finish in about 14 and a half months. The IRR
Okay.
is mid 20s on that on projections. We'll probably wind up above that. But then what we'll wind up doing is we'll wind up transacting once the buildings are stabilized because IRR is also about timeline, right? It's how long that money is working to get it. And if you take an original value add and you then stretch that into 5 or 6 years of cash on cash of 8%, you're taking that initial bump and you're then adding it and averaging it so your IRR is falling substantially. But if I can take you out of a deal in the mid 20s and put you in another deal 18 months later in a tax preferred situation and allow that to then continue to grow in that mid 20s, it doesn't take long to turn a couple hundred grand into a couple million if you're continuing on that path. If you're looking at something different. So what we do is we look at it, we say, okay, this building has done the maximum amount of growth it can do. Then we transition that, we transact that based on a formula. What's always upfront and disclosed is okay. Now we move that to our cash flow group. They're looking at it and they're willing to pay X for it, maybe minus brokerage fees because those aren't a fee that anybody in the deal gets. And then you're setting that up with stabilized financing, and then you're holding that for a 10-year period of time, but you've got a brand new asset, right? You're not going to have to repaint that thing in 10 years because it's brand new. You're not going to be replacing furnaces in 10 years. And so you can get that good, solid, steady cash flow for a long period of time and hold the financing for a long period of time. And so you're able to really create two solid investments out of one, giving both entities exactly what they want instead of trying to throw all the people in the soup and make one thing work for everybody. It's not a one size fits all. Yet a lot of people think that's the way that real estate syndication works, and it's not that at all.
Yeah, that's really interesting. Another question I had, and this is just out of curiosity, when you're going for lending, do the banks view your vertical integration in having the in-house property manager? Do they view that as a plus or a minus? Because I could see some lenders being like, we'd be more comfortable if you had a third party property manager, if for whatever
That's
reasons.
That's definitely the case. Banks definitely like a third party property management, which I look at it and I go, man, what a benefit to me and my investors that the banks want to see the gray stars of the world be the property manager. What we're able to do is then pull out the last 5 or 6 deals we've done and show our expense ratios and show our success rates. And I like the fact that I have to step up and prove myself every single time because the reality is, look, I'm borrowing millions of dollars from the banks, but that's not the part that I'm worried about. We know that they're going to get bailed out if there's a problem. I'm worried about my investors, and I want a third party in my deal that's going, I want everything in this deal to succeed. And I want to look under every rock. I want to look under every crevice. I want to make sure that all the I's are dotted and T's are crossed. And so that third party looking in saying, yes, this is what we need or what we want. Or if you're going to use these other people, they are truly qualified and we sign off on that. So it's not just something where I'm plugging and playing just the way that Shannon wants to, and only the way that Shannon wants to. We're actually doing it in a way that the banks are looking at it going, you know what? You guys are great asset managers. You guys are really good at this property management thing, and you've proven it to us. So we're going to sign off on that so that our investors know that, the bank knows that, everybody's comfortable with the situation. And a lot of times when we've gone into bigger scale stuff, things that are a little bit outside our realm or in other markets, we engage third party property management because they are the best in the area. And it's not a thing. I've never thought that. I always agree that the right property manager will make you more than they ever cost you, but you've got to know what it takes to get that right property manager in there. And it's not always the name. It's not always the biggest firm. It's what are they doing? What is their track record? And how can you employ that track record to make your project the best?
Yeah, and I love that approach that the more scrutiny you get from others, the better, because it forces you to make the stronger case and to show your track record, how good you are, which builds confidence in both you and your investors to know how solid that deal is. Because if any red flags come up, I'm sure you'll be thankful to know them if if they come up before the deal is done, and then you can rectify them then and move on to the benefit of, like I said, you and your investors.
And Tim, to be honest with you, when I was younger, it used to piss me off,
Mm.
right? It used to upset me. Now that I'm older and I see why and I really understand it, it shows me where in my immaturity as a developer, as a general partner, I needed that growth to happen so that I could see why they do it and why it is the best thing to have. You should always be questioning every side of your deal. And so often we pencil whip our spreadsheets, we surround ourselves with people that tell us we're the greatest or whatever, and we don't get that brutal third party truth that we paid for because we don't want to see it. But I've always learned something from the other team too, right? So when you've got third party property management in there, we're constantly evaluating their processes, how they do things. We're breaking that down. We're going, wow, we really what they're doing here. Let's dig into that and incorporate that in ours. Or we can see how this really feels awful and doesn't work. Let's ask them why they're doing it and see if we can't change that because it's not something that's working for us.
Yeah, some super valuable insights in there. All right, Shannon, we do need to move on to the turbo round. So I am going to ask you three questions that I ask every guest that I have on the show, and I just ask you for a quick, honest answer. First question: what is one red flag every investor should look out for?
I think it's the resume. I think there needs to be years of real estate experience on that resume to ensure that you're getting qualified people that are your general partners managing your money.
Yeah, couldn't agree more. And what would you say to those folks who are looking to get into the business though, and they don't have that resume yet?
You know what? The best way to do that is be important to important people. Look, if you're looking to build a resume, align yourself with the winners. Align yourself with the people that have what you want because you're guilty by association. If you're working with good quality people, you're going to be accused of being that, right? If you're working with fly by night turd birds, you're going to be accused of being that, right? So you really need to look at that and make sure that, hey, these guys are like two rungs up the ladder for me. I want to be working with them. I got to find a way to do that. I got to find a way to bring value to them so that I can get them on my resume.
Yeah, love that. All right. What is a myth about this business that you would like to set straight?
It's not a get rich quick. It's not. Real estate is a long game. Projections change, timelines change, lending changes. Everything about real estate changes, but it's the long game that will make you wealthy.
Yeah, amen. Couldn't agree more. All right. What does success look like to you?
This is going to sound funny. The 19th of this month, I'm going to turn 50, and success to me sounds like dying with an LOI in my pocket. I don't ever plan on quitting this game, right? So if I can continue to do deals and continue to serve my investors and continue to help put something out there as an option to the Wall Street casino, that's going to be a very successful life for me.
Yeah, and I think that's an important point, right? When you switch from the corporate to the more entrepreneurial, there is no pension plan at the end of this. There is no matched 401k,
Right.
anything like that. You just got to keep the deal going. And I think the time freedom, the ability to choose, right? Like you could
Yeah.
stop whenever you want to if you get to that point. But if you enjoy doing it, then why would you, right? All right. Hey, Shannon, this has been awesome. Please tell our guests how they can get a hold of you and if there's anything else that you would like to share with them.
The easiest way to get in touch with us is at shannonrobnett.com. All my social platforms are available there. My calendar's available there. I'd love to have a conversation with you guys or your listeners. If there's something I can do to be of service to you guys, I'd love to do it. So shannonrobnett.com.
All right. Thanks again, Shannon, for all the knowledge bombs you dropped in this episode. We'll have all your information in the show notes for the listeners. I definitely appreciate you coming on, and I look forward to seeing you do big things on your journey to multifamily millions.
Thanks, Tim.
Thank you.